welcome to another video. This is Hena, a CPA based off Los Angeles, and today is Thursday, February 4th. What I want to do today is basically focus on tax season. We have it like about a week and a half away, starting late, almost by 2 weeks, historically speaking. And I wanted to take this opportunity to kind of give some pointers about the upcoming tax season and what the majority of people, the ones who lost their jobs or had a significant decrease in their income, kind of look out for when they file the taxes this year. Hopefully you will have someone to guide you, or if you have any questions, feel free to put it in the comment section below. I do read them and I will reply to those. Let's begin with the biggest question that I've been getting a lot is the unemployment. Now, basically, unemployment is non-taxable at the federal level. On the other hand, state is a different story. 15 states in the US do not tax unemployment, the rest do. I'm in California, California does. I did look up one of my clients who we just discussed, Arizona, they do as well. So you will have to look at your state and see if they do tax unemployment or not. So at the end of the day, that tax is going to be due. California does let you set aside about 10% of your unemployment towards that tax. So hopefully those who were on unemployment did check the box to deduct the expenses. And if you did not, I just would want you to be aware that there's a good possibility, if you have been on unemployment for a majority of this year, that you will owe taxes. Generally speaking, of course, everybody is different. The scenario is different. You know what your filing status is, how much of your dependents you have. That will definitely make a difference at the end of the day. Generally speaking, just because we had a lot in terms of unemployment given out earlier with the extra $600, it did come down to the regular, but then we had another $300 added. All of that may be a surprising factor of how much a lot of people did get paid, and that tax bill could be definitely a shocker for a lot. So keep that in mind. Generally speaking, if you're single, your deduction is $12,400. For a married joint is $24,800. At the end of the day, if your unemployment was around that time and that's the income you have, you are perfectly fine, because anything around that time, around that amount, is not even taxable because it kind of takes care of your deduction. The numbers will start after those standard deductions are over and the income starts piling up. Generally speaking, if you are someone who made, let's say you're single, you made about $23,000 in taxes, unemployment this year, you will be looking at about just under $1,000 in taxes, because if I do a calculation out of the $22,000, $12,500 is what your $12,400 is what your standard deduction is. Your income kind of comes down to $9,600, the amount that's going to be taxable. So at 10%, because the bracket is 10% till you hit $9,875. So you basically will owe about $960 in taxes. So at the end of the day, what I'm trying to say is, if you're single with about $24,000, you will owe about $1,000 in taxes. So kind of get ready. I don't want you to, freak out in terms of where you're going to get the money immediately, because you are free to file the taxes as soon as they start on February 12th, but the amount due for your taxes is April 15th. So you don't have to wait to file your tax till April 15th. You can if you want to, but at least I say get on a system, see what your tax liability is, so you're well prepared and you have about two and a half months to kind of put this money together to pay for taxes. So that's definitely the biggest question I've been getting a lot, and just want for you guys out there to not be surprised. One of the things that a lot of my clients this year may benefit just because of this situation is the earned income tax credit. That is usually for It's about 50, anybody earning less than $57,000. You could be single with kids. It's a credit that the government gives you. And so definitely a lot of people who had decrease in their income compared to 2019 can benefit out of that. So make sure you look out for the earned income tax credit. It is refundable. I do have to tell a scenario which I had with one of my clients who did like Uber this year, a young client. So they decided, okay, they have about 30,000 in Uber credits and Uber income, and putting everything else. Their idea was, let me add up all the expenses. I have barely any income. Once I do that, I won't owe any taxes. Technically, yes, but what a lot of people out there are forgetting is this earned income tax credit. Now, if you were to keep you take your decent deductions, you'll be surprised that even if you were to go, let's say you made like $25,000 is what your taxable income is coming out to be from your Uber Eats or any of those businesses, you would still be at no taxes. Rather, if you do have dependents, or even if you don't have dependents but you are under the threshold of the $57,000, the ideal category is between $15,000 to $25,000, you would actually get $3,000 in credit. Now, if you were to make your business income zero, of course you won't pay any taxes, but you are leaving that $3,000 credit on the table. So run some numbers, make sure you are, it's tax, it's tricky, but just because you think you can bring the income down, you won't pay any taxes, doesn't mean it's the ideal scenario. I say let it sit, show some income. You'll be surprised how the credits kind of come in and probably give you a refund, whereas otherwise you would owe no taxes. So in some way, showing income helps. Keep in mind, it is refundable, but you have to show income. It's an earned income credit. If you show zero income, no income is earned, no credit will follow. So keep that in mind. Stimulus check claim. Oh my God, that's a big question. I'm very well aware of the fact that there are a lot of people out there who made a lot less money in 2020 compared to 2019. But since the stimulus checks were based on 2019 tax returns, they were either left out completely or they got less money because of the phase out limits and stuff like that. But please, please, please claim that money when you file your taxes. At the end of the day, the stimulus amount was basically really a rebate against your 2020 tax return. So you are entitled to a larger stimulus assuming the calculations make sense. So please do pay attention. If you think your income, or if your income has dropped, please make sure you file that recovery rebate credit worksheet very carefully and claim the stimulus if you didn't get any, or the extra if something was skimmed off because it was based on the 2019. So definitely pay attention to that. That's also a money you don't want to be leaving on the table. Then I have people who had kids. Of course, it's going to be the same story. You had a kid in 2020, not in 2019. The stimulus was based on 2019 tax return. So when you file your taxes, make sure you claim that dependent and get the extra money. $1,100 is what we're talking about in terms of the $500 in the initial, the round one, and $600 additional for the round two. So that is something you don't want to leave on the table. College students. Now here's a scenario that we'd really kind of taking advantage of how the system is, because you can play catch up. Now, if you are one of those kids who, college students who were dependent on their 2019, return for their parents, on their parents' return, of course, they did not get any money for you if you were over 17. You were an excluded class, or elders too. So if you are one of those people, file your 2020. There is no need, generally speaking, depending on what the category is. Your parents are not getting benefit of not as much claiming you as dependent. You might as well go file your own return and claim the credit on the 2020 tax return, because your parents didn't get that anyways. So you might as well. Something to look for. The interesting thing is, even though you are a standard deduction, a lot of people these days are standard deduction, especially with the change of the TCGA, they are giving a $300 contribution credit, has to be cash, even if you have done standard deductions. It is a one time only, considering, you know, you were generous enough, you were in a situation where you could donate. So if you did some cash donations, keep in mind it would also include, you know, if you have one of those services that like St. Jude, we do it. I do, you know, kind of donate to St. Jude. Kind of, it automatically goes through my card. So generally speaking, that donation is no use to me from a tax perspective, except this year I will be able to claim it. Keep in mind, it has to be a cash donation. It's not your Salvation Army where you kind of giving your stuff away. It has to be cash. So $300, it's above the line. It would be a good one to have on your return. Tax loss harvesting, that's something I'm pretty sure you guys are aware of. If you're not, it's $3,000 of capital loss if you had any stocks, if you played stocks. I know a lot of people did, I guess, sitting at home, you know, didn't have much better things to do. So there are a lot of people who played the stock market, and if you did have losses, ideally you would love to, you should have been able to get some gain against some losses and net it out. But even if at the end of the day you still had major loss compared to gain, you can claim $3,000 of loss on your tax return. And if you have more than that, gets carried forward to the other years. I'm not sure how many will be able to take advantage of something that I'm going to tell right now, but at the end of the day, I think it's still a smart move if you're able to do it, is a saver's credit. It's basically for people who are at the $30,000-$40,000 income range. I know if you can afford to do it, and not everybody right now is in a situation to do it, but if you are one of those people who can afford to do it, take a look into a SEP IRA, get some, or a traditional IRA or SEP, I guess, if you have a business, you did an Uber or Lyft or, you know, one of those things, sure, do a SEP IRA or do a traditional IRA, invest into your retirement, get an early start, or even if this year could be the one that you decide to start. If you do that, besides the regular advantage that you get, if you are between the $30,000, $40,000, $45,000 range, you do get something that's called a saver's credit. It is targeted, as you can already tell, to a certain income threshold. And what it does is, the best 50% up to $2,000 is refundable credit to you. So if you were to put $2,000, you get $1,000 credit. Essentially, you are putting $1,000, but getting a benefit of $2,000 sitting in your retirement, because $1,000 kind of came through you, through the return back to you. There will be a lot of people this year that I know who would think, I don't need to file return. I didn't make too much of money, and I'm under the threshold. I do see the point, but believe me, you want to file return. You want to file return because to make sure your calculation on the stimulus is right. You want to file it to make sure if you are and can qualify for earned income tax credit, especially if you have dependents. And it could be anyone. It could be your kids, your parents, your grandparents, your nieces, your nephews, anybody that you are paying 50% for them, for their expenses, towards their expenses, you can claim on your tax return. And so even, and basically take advantage of it. You may think you don't owe taxes, but you could be owed money back in terms of credits from the government. Plus, the other downside is, I do not want anybody to have to later pay failure to file penalty. It's a steep one. It's 5% per month. You don't want to be caught doing that. So definitely take a look at it. Do run the numbers. I say file it, and there's no harm. So you might as well get that taken care of. I think I kind of covered everything I wanted to for the immediate tax season. I do like to end my videos on a positive quote. The one I found today is by Will Rogers, and it goes like this: "Don't let yesterday take too much of today." You guys have a great evening, and I will see you soon in the next video. Do like and subscribe. I would really appreciate it.